Hidden truth about money creation. Did you know that when you deposit $100 in your bank, they can legally lend out $90 of it to someone else? They collect interest on that loan while giving you practically nothing in return. This is completely legal and called fractional reserve banking. This represents just one aspect of how our financial system operates behind the scenes. From your wallet cash to crushing student loans, a hidden world of financial control affects every dollar you earn, connecting your daily transactions to larger economic forces most people never see. Understanding these mechanisms reveals why your personal finances work the way they do. Yet most have no clue how it all functions. Your student loan's secret journey. What if I told you your student loan isn't just sitting in some boring bank vault? It's actually on a wild adventure through the global financial system. That $30,000 you borrowed to pay for your degree? Yeah, it's living a way more exciting life than most of us. Let's rewind to that moment when you signed your loan papers. Remember how relieved you felt? Finally, I can pay my tuition. But here's where things get interesting. That money didn't come from some giant pile of cash your bank had stashed away. The truth is way weirder. When you signed those papers, the bank essentially created most of that money on the spot, like a financial magician pulling dollars from thin air. They didn't have $30,000 reserved just for you. Banking regulations only required them to have a fraction, maybe $3,000, actually sitting in their reserves. This is your first peek behind the financial curtain. Banks don't lend money they have. They create money by making loans. Your student loan literally expanded the amount of money in the economy the moment it was approved. The journey of your loan begins here, but quickly accelerates. Once that newly created money hits your school's bank account, your loan paperwork starts its own adventure. Within weeks, your original lender bundles it together with thousands of other student loans into something called a student loan asset-backed security, or slabs. Think of slabs like a giant financial sandwich. Each layer contains slices of different student loans, some from medical students, some from undergrads, some from law students. These sandwiches get rated based on how likely the students are to pay back their loans. Then they're sold to investors who want a steady stream of income, your monthly payments. Who buys these loan sandwiches? Everyone from pension funds managing teachers' retirement accounts to foreign investors looking for reliable American assets. That means the monthly payment you make might eventually end up in the pocket of a retired teacher in Florida or an investment fund in Japan. Your financial stress is literally funding someone else's financial security. Take Sarah, a recent nursing graduate with $45,000 in loans. Each month, she skips meals to make her $400 payment, unaware that her sacrifice is providing steady returns for a pension fund supporting retirees who never have to worry about their next meal. When you make a payment, it doesn't go directly to whoever owns your loan now. It travels through a loan servicer first. They take a cut for managing your account and dealing with your frustrated phone calls about why your balance seems to never go down. After the servicer takes their slice, your money continues flowing through the system. Some goes to the investors who bought those slabs. Some might go to insurance companies that sold protection against defaults. And a portion often goes to banks that provided additional financing to the whole operation. By the time your money reaches its final destination, up to a dozen different companies might have taken their cut. The system is designed to extract maximum value from your debt, not to help you become debt-free quickly. Now let's talk about that interest rate on your loan. That pesky percentage keeping you up at night. That wasn't randomly picked. It's connected to decisions made by people in fancy boardrooms you'll never be invited to. Your interest rate is typically based on the prime rate, or LIBOR plus some extra percentage. These base rates are influenced directly by the Federal Reserve's monetary policy. So when the Fed decides to raise rates to cool down the economy, your student loan payment might increase if you have a variable rate loan. The people making these decisions aren't thinking about how it affects your ability to make rent this month. They're focused on macroeconomic factors, inflation targets, and employment statistics. Your financial struggle is collateral damage in their bigger economic game. That knot in your stomach when you check your loan balance? That's not just about money, it's about power. The stress you feel about your student loans is a direct result of a system designed to generate profits for financial institutions. Every dollar of interest you pay goes into this massive financial machine. Your 10-year repayment plan provides a decade of reliable income for investors. Your struggle to make payments during tough times is merely default risk, calculated into complex financial models. Here's something more frustrating. The federal government backs many student loans, meaning if you default, taxpayers cover the loss, not the investors who've been profiting from your payments. It's a sweet deal for them. Heads they win, tails the public loses. Your single student loan, combined with millions of others, has become a foundation of our modern financial system. The total student loan debt in America is over $1.7 trillion. This massive sum has become a financial asset that countless institutions depend on for their bottom line, while the average borrower spends 20 years paying off their undergraduate loans. Your loan connects you directly to Wall Street trading floors where slabs are bought and sold every day. It connects you to central bank decisions about interest rates and monetary policy. It even connects you to global economic policies as international investors buy up American student debt as a safe investment. That $30,000 you borrowed, it's a tiny thread in a massive global financial web. When you make your monthly payment, you're feeding a system that stretches from your bank account to the farthest corners of the global economy. This is why politicians argue so fiercely about student loan forgiveness. It's about what happens to this entire financial ecosystem if the debt suddenly disappeared. Who would lose money? Whose investments would suddenly become worthless? The answers to these questions have multi-billion-dollar implications. The money creation magic trick. Politicians fighting over student loan forgiveness are just the surface battle in a much deeper financial magic show. What if I told you that the $1.7 trillion in student loan debt was created literally out of thin air? Not metaphorically. I mean literally conjured into existence through a banking trick that would make David Copperfield jealous. The whole system operates on an illusion so powerful that most people never question it, even though it shapes every aspect of our financial lives. Remember those childhood piggy banks where you'd save up your allowance? That's how most of us were taught to think about banking. You put money in, it sits there safely, and maybe the bank loans some of it out while paying you a tiny bit of interest. Simple, right? Well, I hate to break it to you, but that mental model is completely outdated. Your modern bank isn't a piggy bank. It's more like a digital money printer with government authorization. What if your bank is printing money every time you deposit $1? This isn't fiction, it's reality. When you deposit $1,000 in your checking account, the bank keeps only a small fraction on hand, maybe just $100, and uses your deposit as the foundation to create new money through loans. Here's the mind-blowing part. When the bank loans out $900 of your deposit, your account still shows $1,000, and now someone else has $900 that didn't exist before. The bank just created $900 of brand new money with a few keystrokes. This is exactly how our banking system is designed to work. It gets even more magical. When the borrower spends that newly created $900, that money eventually gets deposited in another bank. That second bank then creates even more money based on that deposit. Keeping 10% in reserve, they loan out $810. Now there's your original $1,000, plus the $900 from the first loan, plus another $810, all from your initial deposit. This process continues throughout the banking system in what economists call the money multiplier effect. Through this cycle, your original $1,000 deposit could theoretically generate up to $10,000 in new money throughout the economy, like a photocopier for cash that slightly shrinks each copy, but keeps duplicating. This is standard economic doctrine taught in universities and acknowledged by central banks worldwide. The Bank of England published a paper in 2014 stating clearly, whenever a bank makes a loan, it simultaneously creates a matching deposit in the borrower's bank account, thereby creating new money. The Federal Reserve explains this process too, though in technical language that obscures its simplicity. This system, fractional reserve banking, explains why the total money in circulation dwarfs the physical cash that exists. In the US, physical currency only accounts for about 11% of the total money supply. The other 89% exists only as numbers in computer systems, created largely through lending. When functioning well, this system fuels economic growth. Banks create money to fund businesses, homes, education, and consumption, generating jobs and prosperity. But it's a double-edged sword that can create massive boom and bust cycles. Consider the 2008 financial crisis. Banks became too liberal with their money creation. Powers, especially in housing. They created trillions through mortgage loans, often to people who couldn't afford them. This newly created money flooded housing, driving prices to unsustainable levels. When defaults began, the system reversed. Banks stopped creating money and started demanding repayment, causing a massive contraction in the money supply, resulting in the worst economic crisis since the Great Depression. Almost every financial crisis follows this pattern. Excessive money creation leads to asset bubbles that eventually pop and cause economic devastation. The 2000 dot-com bubble and the 1929 stock market crash were both fueled by excessive bank-created money. Surprisingly few people understand this fundamental reality. A 2017 poll found that only 10% of British MPs correctly understood how money is created. Most politicians, making decisions about our financial system, still think banks simply loan out deposits. Even economics textbooks often describe a version of banking that hasn't existed for decades, portraying banks as financial intermediaries rather than money creators. The implications are profound. Private banks, not just the government, control the money supply. Every loan approval is a decision about how much money should exist in our economy. Banks essentially have a license to create money, one of the most valuable privileges imaginable. It's like having a legal tender printer, except it's electronic. This money creation ability explains why banking is extraordinarily profitable compared to most industries. While most businesses must make or provide something to earn money, banks can create it from nothing, then charge interest on it, an unparalleled business model. It transforms how we should view the national debt. When politicians worry about government borrowing, they rarely mention that much of that money is created by private banks just like any other loan. The government isn't simply spending tax dollars. Often they're spending newly created money that didn't exist until borrowed. This touches just the surface of money creation. Our financial system contains layers of complexity, from central banks to shadow banking to global currency markets. But understanding that banks create money when making loans is essential to comprehending how our economy functions. Central banks, the economy's invisible hand. Those layers of complexity I mentioned? At the very top sits an institution so powerful it can make your savings account worthless or your mortgage unbearable overnight, without asking your permission. Central banks operate like financial gods, creating and destroying economic opportunities with the subtle adjustment of a single interest rate, all while most people are too busy working to notice who's actually controlling their financial fate. Let's talk about the Federal Reserve, the Fed for short. These powerful financial decision makers directly impact whether you can afford a house next year or if your credit card will suddenly cost you hundreds more in interest. Yet most Americans couldn't name a single Fed official besides the chair. This influential group meets 8 times a year in what they call the Federal Open Market Committee. Behind closed doors, they decide one number that sends shockwaves through every aspect of the economy: the federal funds rate. This is the interest rate that banks charge each other for overnight loans. This single number affects everything in your financial life. When the Fed raises this rate by even a quarter of a percentage point, 0.25%, it triggers a domino effect. Here's a concrete example. With a $300,000 mortgage, that tiny 0.25% increase translates to roughly $50 more per month on your payment. Over a 30-year loan, you're paying an extra $18,000. And that's just from one small adjustment. During inflation periods, they might hike rates several times in a row. Credit cards experience these changes even more dramatically. Most cards have variable rates tied directly to the Fed's decisions. A series of Fed rate hikes can push your credit card interest from 18% to 24% in a matter of months. On a $5,000 balance, that means paying $1,200 in annual interest instead of $900. They make these decisions without sending you any personal notification. You simply get stuck with the bill. Central banks do more than adjust interest rates. They create money when the economy faces trouble. During the 2008 financial crisis, the Fed created hundreds of billions of dollars to prevent banks from collapsing. They simply typed numbers into a computer. They have a digital money creation system that makes banks' money creation look minuscule by comparison. In 2020, when the pandemic hit and markets started crashing, the Fed announced unlimited support to financial markets. That announcement alone caused stocks to jump, saving billions in wealth for asset owners. Meanwhile, if you were living paycheck to paycheck, the benefits were minimal. This illustrates an important reality about central banks. Their policies create clear winners and losers. When the Fed cuts interest rates to stimulate the economy, people who own stocks, real estate, or other assets benefit as those assets increase in value. But if you're saving money in a bank account, you might get 0.5% interest, while inflation reduces your purchasing power at 2 to 3% annually. Your financially responsible behavior actually costs you money. Central banks also function as the lender of last resort, the emergency financial system doctor. When banks risk collapse, they can access the Fed's discount window to borrow massive amounts of cash. It's comparable to having someone who will always provide bail money, no questions asked. When was the last time someone offered to bail you out after poor financial decisions? The independence of central banks serves as both strength and controversy. They're designed to be insulated from political pressure to make tough decisions when needed. This creates a democratic paradox. Some of the most consequential economic decisions affecting daily life come from unelected officials who can't be removed by voters. Central banks can dramatically shift direction depending on leadership. In 2018, current Fed Chair Jerome Powell was consistently raising interest rates, making mortgages more expensive and slowing economic growth. Then in 2019, he reversed course and started cutting rates under pressure from Wall Street and the White House, challenging the notion of true political independence. A powerful example of central bank influence occurred in December 2015, when the Fed raised interest rates for the first time in nearly a decade. Within weeks, global stock markets lost trillions in value, with effects reaching China's economy. One meeting created global consequences, all from an institution most people couldn't locate on a Washington, D.C. map. This influence extends globally. When the Fed acts, central banks in Canada, Europe, Japan, and emerging markets often must respond, even when it's inappropriate for their economies. It's like a global orchestra where some musicians must play notes they know are wrong. Central bankers aren't infallible financial wizards. They make significant mistakes. In 2007, Fed Chair Ben Bernanke claimed the subprime mortgage market problems seemed likely to be contained. They weren't. They nearly collapsed the entire global financial system. Yet these institutions retain enormous power despite repeatedly missing major economic turning points. The connection between their boardroom and your wallet is direct and immediate. When the Fed announces policy changes, algorithmic trades execute instantly. Within milliseconds, mortgage rates adjust, bond yields shift, and stock values change. The financial impact on your life is determined before you hear about it on the news. For average Americans, these decisions create real consequences. Home affordability, debt burden, small business loan approval, and retirement account growth or decline. All determined by economists in a room you'll never enter, making decisions based on models and theories that often fail to capture ordinary people's real-world struggles. Quantitative easing, the money printer goes BRRR. While economists were debating policy in those exclusive boardrooms, something unprecedented was happening to the global economy. Remember when the Fed's balance sheet was under $1 trillion? Today it's over $8 trillion. That's 8 times more financial firepower than before 2008. Where did all that money come from? And more importantly, where did it go? When traditional tools weren't cutting it during the 2008 financial crisis, central banks looked at their economics textbooks, tossed them out the window, and tried something revolutionary. That something was quantitative easing, QE for short, arguably the biggest economic experiment of our lifetimes. Think about it like this. When your car gets stuck in mud, you first try giving it a little gas. If that doesn't work, you push harder on the accelerator. When the financial system got stuck in 2008, central banks tried cutting interest rates, a little gas. When that proved insufficient, they slammed the monetary accelerator to the floor with QE. What exactly happens during QE? The central bank creates new money digitally, not by printing physical bills, but by adding zeros to its account balance, and uses that freshly created money to buy government bonds and other securities from banks and financial institutions. This floods the financial system with cash, which in theory should stimulate lending and economic activity. The scale of this experiment has been staggering. After the 2008 crisis, the Federal Reserve launched multiple rounds of QE, QE1, QE2, and QE3, pumping trillions into the financial system. In late 2008, QE1 introduced $1.5 trillion, helping stabilize plummeting markets. Then came the pandemic in 2020, and the Fed unleashed a monetary response that dwarfed previous programs. In just a few weeks, they created more money than during years of post-2008 interventions. The European Central Bank, Bank of Japan, and Bank of England all implemented similar massive QE programs. The Bank of Japan's asset purchases were so extensive they now own about half of all Japanese government bonds and are major shareholders in many Japanese companies through their stock purchases. This is where consequences become apparent. The new money didn't flow evenly throughout the economy. Instead, it primarily inflated asset prices, stocks, bonds, real estate, creating wealth for those who already own these assets. Each round of QE correlates directly with market surges. Following QE1 in 2009, the S&P 500 rose 26%. After QE2 in 2010, stocks climbed another 30% over 18 months. Overall, the S&P 500 has more than quadrupled since QE began in 2008. Meanwhile, wages for average workers barely kept pace with inflation, creating a disconnect between market performance and everyday economic reality. This disparity produced what economists call the K-shaped recovery, where Americans' financial fortunes diverged dramatically. If you owned significant assets before QE, you likely saw your wealth multiply. If you were saving for your first home or building a modest investment portfolio, you watched prices climb further out of reach while your bank account earned essentially zero interest. Corporate America quickly leveraged this new reality. With borrowing costs at historic lows thanks to QE, companies went on a borrowing spree. But rather than using this cheap money to build new factories or hire more workers, many companies bought back their own stock, boosting share prices and executive bonuses. Between 2009 and 2019, S&P 500 companies spent over $5 trillion on stock buybacks, enough to send every American household a check for about $40,000. Instead, it went toward enhancing share prices that primarily benefit the wealthiest Americans, who own the vast majority of stocks. The housing market tells a similar story. As QE pushed mortgage rates down, housing prices surged. In 2010, the median home price was about $220,000. By 2022, it had jumped to over $400,000, an 82% increase. Great if you already owned a home. Devastating if you were a first-time buyer watching homes become increasingly unaffordable despite the low interest rates. Meanwhile, the real economy, where regular people work jobs, earn wages, and buy groceries, hasn't seen comparable benefits. GDP growth has been modest, and wage growth for most workers has barely kept up with inflation. The gap between Wall Street and Main Street widened considerably. QE has created significant distortions in financial markets. With central banks buying massive amounts of government bonds, they've driven yields to historically low levels. This has pushed investors into increasingly risky assets in search of returns, creating what some call everything bubbles, where nearly all asset classes become overvalued simultaneously. A crucial question remains unanswered. How does this all end? Central banks now own trillions in assets they'll eventually need to sell back to the market, a process called quantitative tightening. But every time they've tried to meaningfully reduce their balance sheets, markets have reacted poorly, forcing them to reverse course. We saw this in 2018 when the Fed attempted to normalize its balance sheet and raise interest rates. Markets tumbled, and the Fed quickly backed off. The pandemic then forced them to double down on QE. They appear trapped, unable to withdraw monetary stimulus without destabilizing the markets they've been supporting. Some economists worry we're now dependent on monetary stimulus, that the economy and markets can't function without constant central bank support. Others fear this money creation will eventually trigger runaway inflation, pointing to recent inflation surges as just the beginning. The truth is, nobody knows for sure how this ends because we've never done anything like this before. We're in uncharted territory, conducting a global monetary experiment in hidden markets with no historical precedent. While QE transformed the financial landscape for everyday savers, there's an even darker transformation happening to stock markets themselves. Did you know when you click buy on your fancy brokerage app, That trade probably isn't happening where you think it is. That iconic NYSE trading floor you see on TV with all the screens and shouting? Mostly just theater these days. The real action happens in secretive private venues with the decidedly creepy name of dark pools. Where up to 40% of all U.S. stock trading now takes place completely hidden from public view. Let's be real for a second. When you picture the stock market, you're probably imagining a transparent system where buyers and sellers meet to trade fairly. But the modern reality is far more complicated and honestly kind of sketchy. Think of dark pools as exclusive underground clubs where VIPs make deals behind velvet ropes, while the rest of us are left in the regular, brightly lit venue where everyone can see our moves. These dark pools are private trading venues operated by major banks and financial institutions where massive investors can trade huge blocks of stocks in secret. Here's a concrete example. When a major hedge fund wants to unload 10 million shares of Tesla, they don't want to show their hand. If they place that order on the public NYSE, everyone would see it, and the price would immediately tank before they could finish selling. Instead, they quietly execute the trade in a dark pool. The public sees nothing until after the transaction is complete, by which time the big players have already made their moves, potentially leaving regular investors holding the bag. Why should this matter to you? Imagine playing poker where the richest players at the table keep their cards hidden until after you've placed your bets. That's essentially what's happening to your retirement savings. While you trade based on publicly available information, the big players make moves in secret, seeing order flows and price data you'll never access. The shift towards secrecy is dramatic. In 2009, dark pools handled about 16% of U.S. stock trades. Today, it's hovering around 40 to 50%. Almost half of all trading happens in secretive venues most retail investors can't even access. But dark pools are just the beginning of this shadow market. High-frequency trading firms have created another layer of unfairness. Think of these traders as having superhuman reflexes in a marketplace where speed determines who wins. These companies have positioned specialized computers right next to exchange servers, giving them a speed advantage measured in microseconds. In the algorithmic trading world, a microsecond advantage is like having a time machine. These high-frequency traders use their speed advantage to engage in what's called front-running. It's like someone seeing you heading to the store to buy the last gallon of milk, then racing ahead to buy it first, only to sell it to you at a markup when you arrive. When you decide to buy Apple shares at $180, your order information might be sold to a high-frequency trading firm. They see your order coming, quickly buy Apple shares at $180, and then sell them to you for $180.05. 5 cents multiplied by millions of trades daily equals billions in profits skimmed from regular investors. The lengths these firms go to for speed advantages are astounding. Michael Lewis's book Flash Boys exposed how they build special fiber optic cables in straight lines between financial centers, drilling through mountains, just to gain millisecond advantages. One firm spent $300 million on a cable from Chicago to New Jersey that made their trades 3 milliseconds faster. Literally faster than you can blink. And the investment paid for itself in less than a year. This Wall Street shoddiness directly impacts your investments. When markets aren't transparent, price discovery gets distorted. The 2010 flash crash showed the dangers when the Dow dropped nearly 1,000 points in minutes before rebounding. Your 401k could have lost 10% of its value in literal minutes because of computers trading with other computers in dark venues. Dark pools are also less regulated by design. In 2016, Barclays and Credit Suisse paid $154 million in fines for misleading investors about how their dark pools operated. They promised protection from predatory traders while actually giving those same traders special access. Regular investors paid worse prices while thinking they were being protected. The SEC consistently plays catch-up. By the time they identify one sketchy practice, Wall Street has invented 3 new ones. It's financial whack-a-mole with your retirement savings on the line. Fragmented trading across dozens of dark venues makes maintaining liquidity during market stress harder. When things get scary, these shadow markets might actually make a crash worse. Your own retirement fund manager might be using dark pools too, justifying it by getting slightly better prices by hiding their trades. So your 401k might benefit in small ways from the same system that's potentially undermining market fairness overall. Defenders claim these practices make markets more efficient and provide liquidity. But if that were true, why would Wall Street fight so hard against reforms that would increase transparency? Opacity benefits insiders. Transparency would benefit everyone else. For regular investors, this shadow market means accepting you're playing a game where the rules favor the house. It doesn't mean you shouldn't invest. The stock market remains one of the best ways to build wealth over time, but it does mean understanding that the system has built-in disadvantages working against you. Wall Street's warning signs. You know that feeling when you're the last one to get the joke. That might be happening with your investment portfolio right now. While social media is flooded with to-the-moon stock tips and record numbers of new investors are downloading trading apps, the billionaires and corporate insiders who actually have access to the real information are quietly converting their stocks to cash at the fastest pace in years. The suits on Wall Street are saying buy, buy, buy on financial news networks, but behind closed doors, they're cashing out their own investments faster than free pizza disappears at a college dorm. Corporate executives, the CEOs, CFOs, and other top brass who know their companies better than anyone, have been selling their personal shares at historic rates. In 2021 alone, insiders sold $69 billion worth of stock, nearly double the previous year. This trend has continued into recent quarters. These same executives go on earnings calls talking about tremendous growth opportunities, while simultaneously dumping their personal stakes. Consider Mark, a 37-year-old engineer who finally started investing his savings in 2021 after watching his neighbors boast about their market gains. He carefully followed financial news recommendations, only to watch his portfolio drop 30%, while learning that the CEO of his largest stock holding had sold millions in shares just weeks before a disappointing earnings report. Elon Musk provides a high-profile example. In 2021, he sold over $16 billion of Tesla stock, more shares than many companies are even worth. Jeff Bezos has liquidated over $20 billion in Amazon stock in recent years. Across the board, the ratio of insider selling to buying has reached alarming levels. For every dollar of stock insiders purchase, they're selling nearly $20 worth. Warren Buffett's actions tell an equally compelling story. Buffett's Berkshire Hathaway sits on a cash pile approaching $150 billion, one of the largest cash reserves the company has ever held. One of history's most successful investors chooses to hold enormous amounts of cash rather than invest in stocks at current prices. His actions speak volumes about today's market valuations. Meanwhile, everyday investors pour money into the market at unprecedented rates. During the pandemic, more than 10 million new brokerage accounts opened as stimulus checks and lockdown boredom created a perfect storm of retail trading. Apps like Robinhood made buying stocks as easy as ordering pizza. But while regular folks invest their savings, the smart money heads toward the exits. Margin debt, money investors borrow to buy stocks, has exploded to all-time highs, recently crossing $900 billion. When markets fall, these leveraged investors face margin calls, forcing them to sell stocks quickly. This creates a downward spiral in prices that can devastate ordinary investors' portfolios. The last two times margin debt spiked like this preceded the 2000 dot-com crash and the 2008 financial crisis. Wall Street keeps creating exotic investment products for retail customers. Leveraged ETFs promising 2x or 3x returns, inverse volatility products, and cryptocurrency tokens backed by hype. These generate commissions for firms selling them, but often cost retail investors dearly when markets turn volatile. Major investment banks publish bullish research reports recommending stocks, while their proprietary trading desks might take opposite positions. Goldman Sachs paid a $550 million fine for selling mortgage-backed securities to clients while simultaneously betting against those same securities. The flood of IPOs and SPACs signals another warning. In 2021, more than 1,000 companies went public, raising over $300 billion. Many were unprofitable and trading at astronomical valuations based on projected future growth rather than current earnings. When companies rush to go public, insiders often know it's time to cash out at premium valuations. The growing disconnect between market performance and economic reality adds concern. While indexes post record highs, median household income barely keeps pace with inflation. Today's market movements seem more tied to central bank policies than economic fundamentals. Jeremy Grantham, who correctly predicted the 2000 and 2008 bubbles, warns about a super bubble in stocks, bonds, housing, and commodities. He notes that today's valuation metrics exceed those seen during the 1929 market crash that preceded the Great Depression. What does this mean for your investments? When insiders start exiting while retail investors pile in, it often signals trouble. Markets can remain disconnected from fundamentals longer than expected, but caution may be warranted over aggressive risk-taking. Most retail investors buy most at market tops and sell at bottoms. Professional investors often do the opposite, selling into strength and buying into panic. This pattern repeats throughout market history, with regular investors typically ending up on the wrong side. This doesn't mean panic or pulling all money from the market. Long-term investing still makes sense for most people. Understanding these warning signs helps adjust expectations and risk levels. Consider keeping some cash ready to take advantage of better prices if markets correct, or rebalance away from speculative assets towards stable value investments. The bottom line, there's a growing divergence between Wall Street's public statements and informed investors' actual behavior. When corporate insiders, billionaire investors, and Wall Street firms quietly reduce their stock exposure while telling everyone else to keep buying, that's information worth heeding. Geopolitical dominoes. While Wall Street whispers warnings to insiders, there's another type of signal that might be flashing red on your financial dashboard, and it's happening halfway across the globe. That military tension in the South China Sea, or those protests in a major oil-producing country, are potential financial tsunamis heading straight for your wallet. We live in a world where everything's connected through invisible financial wires, creating a massive economic domino effect that can start with a political decision in Moscow and end with your retirement account taking a hit in Milwaukee. Remember when gas prices suddenly shot up and everyone was blaming international tensions? This was financial reality. When Russia invaded Ukraine in 2022, global oil prices spiked almost instantly by over 30%. For the average American, that translated to paying an extra $30 plus every time they filled up their tank. Those higher energy costs rippled through the entire economy, raising prices on everything from groceries to airline tickets. One geopolitical event ultimately cost the typical household over $450 per month in higher prices, equivalent to a car payment for many families. This pattern has repeated throughout history. In 1973, when OPEC imposed an oil embargo against countries supporting Israel, oil prices quadrupled practically overnight. The U.S. stock market dropped 48% in response, and the economy plunged into recession. Millions lost their jobs, and homeowners watched property values collapse, all because of a political decision made thousands of miles away. These economic ripples extend far beyond oil markets. When Brexit happened in 2016, it unexpectedly affected mortgage rates in California. Global investors, seeking safety amid European uncertainty, poured money into U.S. Treasury bonds. This influx pushed down U.S. mortgage rates by nearly 0.5%, saving some American homeowners hundreds each month. A political decision in London directly benefited homeowners in Los Angeles, demonstrating how interconnected our financial system has become. China's economic policies create similar waves. When China devalued its currency in 2015, it triggered a global market sell-off that wiped out over $5 trillion in value from stock markets worldwide. The average American retirement account lost around $4,000 in value, potentially delaying retirement plans for thousands of workers. These geopolitical shocks travel through our financial system at lightning speed. In the 1990s, it might have taken weeks for an Asian currency crisis to affect U.S. markets. Today, minutes. When North Korea conducted missile tests in 2017, algorithmic trading programs detected the news and started selling stocks before most humans even heard about it. These automated systems execute pre-programmed instructions to dump assets when certain risk indicators flash red. Trade tensions particularly impact consumer pocketbooks. The 2018 to 2019 U.S.-China trade war led to tariffs on hundreds of billions of dollars of goods. Americans paid an estimated $80 billion in higher prices as a direct result, about $600 per household. Washing machines and refrigerators cost 12% more. The latest iPhone? Add another $100. Even avocado toast became more expensive as agricultural tariffs took effect. Resource conflicts in specific regions create targeted price spikes on everyday products. When civil unrest disrupted cocoa exports in West Africa in 2020, chocolate prices jumped nearly 15%. Coffee prices doubled after unusual frost damaged Brazilian crops in 2021. China controls about 80% of the global supply of rare earth minerals needed for smartphones and electric vehicles, giving them leverage that directly impacts consumer technology prices. Financial institutions and central banks try to manage these geopolitical risks with mixed results. When the Arab Spring uprisings threatened oil supplies in 2011, central banks globally prepared emergency measures to prevent market freezes. In 2022, as Russian sanctions took hold, financial institutions scrambled to unwind billions in cross-border transactions. During times of severe geopolitical stress, different assets move in predictable but opposite directions. When Russia annexed Crimea in 2014, gold prices jumped 15%, while emerging market stocks fell by the same percentage. U.S. Treasury bonds typically rally during global tensions. Their yields dropped from 5% to below 2% during the worst phases of the 2008 financial crisis. Even Bitcoin dropped 40% when COVID-19 first shook global markets, proving cryptocurrencies aren't immune to geopolitical risk. The same event creates winners and losers. When Middle East tensions spike oil prices, consumers suffer at the gas pump while energy company shareholders see gains. When political instability sends investors fleeing to the dollar, American travelers get better exchange rates abroad, but U.S. exporters struggle as their products become more expensive overseas. These geopolitical dominoes often trigger chain reactions lasting far longer than the headlines. After September 11th, increased security measures permanently raised shipping costs by an estimated 1 to 3%, affecting virtually every imported product. The 2011 Japan tsunami disrupted global supply chains for nearly 2 years. COVID-19's impact continues to affect everything from lumber prices to microchip shortages. What makes this particularly challenging is that these risks are nearly impossible to predict. Pentagon analysts with classified intelligence still can't consistently forecast which regional conflict will escalate. Economic experts frequently miss how a political decision in one country will affect commodity prices globally. For your personal finances, diversification becomes financial self-defense against geopolitical shocks. When U.S. sanctions on Russian aluminum producer Rusal in 2018 spiked global aluminum prices 30% in a single day, investors holding both aluminum producers and consumer goods companies experienced offsetting effects. Losses in one sector balanced by gains in another. Currency markets react particularly violently to geopolitical events. When Turkey faced sanctions in 2018, the lira lost nearly 40% against the dollar in weeks. Americans with vacation plans to Istanbul suddenly found their dollars stretching much further, while Turkish citizens saw their life savings effectively cut in half, turning middle-class families into poverty cases overnight. The financial system's winners and losers. Currency collapses might seem like distant news stories, but they reveal something much darker about our financial system. It consistently creates extreme winners and losers from the exact same event. Ever wonder why your 401k keeps growing while you still feel broke? The uncomfortable truth is that the financial game has different rulebooks for different players. In any economic scenario, booms, busts, inflations, deflations, certain groups always come out ahead while others fall behind. The financial system contains structural advantages and disadvantages that sort us into winners and losers by design. Imagine our economy as a casino where some players receive loaded dice and marked cards while others play with standard equipment. The house always wins, but some guests have been slipped the house's playbook. Take asset owners, financial institutions, and those with access to cheap capital. They consistently benefit from our current setup. Since 1989, the wealthiest 1% of Americans have increased their share of the nation's wealth from about 30% to nearly 40%, while the bottom 50% collectively own just 2%, less than 3 decades ago. This wealth gap accelerated dramatically after major financial interventions. Following massive monetary policies after 2008, the stock market recovered while wages stagnated for years. From 2009 to 2020, The richest 1% captured nearly 35% of all wealth created in the economy, while the bottom 50% received just 4%. Inflation creates another line dividing winners from losers. For retirees or those on disability benefits, inflation functions as a stealth tax, eroding purchasing power month after month. Meanwhile, homeowners with 30-year fixed mortgages benefit as they pay back loans with money worth less over time. Someone who bought a house in 2019 with a $2,000 monthly payment still pays that same amount, even though $2,000 today purchases significantly less of everything else. Their debt burden shrinks while their asset potentially appreciates. Even more troubling is how inflation impacts necessities versus luxury goods. Between 2000 and 2022, college tuition increased by about 180%, and healthcare costs jumped roughly 110%, while televisions became 90% cheaper. The items essential for building wealth and security have skyrocketed, while discretionary purchases have become more affordable, disproportionately hurting those trying to climb the economic ladder. The financial knowledge gap creates another division. Wall Street benefits from finance appearing complicated, justifying fees, and maintaining their edge. Schools rarely teach financial education, leaving most Americans to learn through costly mistakes. Those with insider knowledge position themselves advantageously before the general public understands market shifts. During the GameStop phenomenon of early 2021, sophisticated traders had already implemented complex options strategies to profit from volatility, while retail investors were still deciphering the situation. This knowledge asymmetry repeats across virtually every market, from cryptocurrency to real estate to retirement planning. Timing represents perhaps the most arbitrary advantage. Someone graduating college in 2010 faced difficult employment prospects, but could purchase stocks and real estate at bargain prices, potentially gaining millions in appreciation over their lifetime. Compare this to 2022 graduates entering a housing market where median homes cost over 7 times the median income, up from 5 times a decade earlier. Similarly, investing at the beginning of a bull market might create an inflated sense of investing skill, while entering during a downturn can lead to permanent risk aversion, missing future recoveries. These timing factors create lifelong wealth disparities unrelated to effort, intelligence, or character. The system inevitably produces financial disparities regardless of individual choices. Today's average CEO makes 399 times more than typical workers, compared to 20 times in the 1960s, reflecting structural changes in how our financial system allocates rewards rather than increased CEO talent or work ethic. Even during apparent economic prosperity, benefits remain unevenly distributed. In 2019, before the pandemic, despite record stock market highs and low unemployment, 40% of Americans couldn't cover a $400 emergency expense without borrowing. Nearly 80% reported living paycheck to paycheck, at least occasionally. These statistics represent millions working harder than ever while feeling increasingly insecure. Location creates another significant divide. Being born in financial centers like San Francisco or New York provides opportunities, networks, and resources unavailable in rural America. This geographic lottery creates dramatically different financial trajectories, compounding across generations. The tax system reinforces these advantages. Investment income typically receives lower tax rates than income from work. A hedge fund manager earning millions from capital gains often pays a lower effective tax rate than teachers or nurses paying ordinary income tax rates. Even bankruptcy protection varies by social position. Major corporations use Chapter 11 to reorganize, often emerging stronger while shedding obligations to workers and creditors. Meanwhile, student loan debt, disproportionately held by younger, less affluent Americans, generally cannot be discharged through bankruptcy. For approximately 45% of Americans owning no stocks whatsoever, market gains are meaningless. Another 40% own small amounts through retirement accounts they cannot access for decades, providing little immediate benefit to daily finances. This disconnect between economic indicators and lived experience is supported by data. From 1979 to 2020, worker productivity increased about 62%, while average hourly compensation grew just 17.5% after inflation adjustment. The gap between worker productivity and compensation, your personal
has steadily
financial
widened
defense
regardless
plan.
of which
That
political
productivity
party held
compensation
power.
gap isn't just depressing data. It's a wake-up call to stop playing by outdated financial rules. While most people follow the same financial playbook their parents used, the economy has fundamentally transformed. Those who understand the actual mechanics of today's financial system can position themselves to avoid the worst downturns and potentially benefit from the same trends that might harm others. It's about understanding how money really moves. What if you could shield your financial future from the next crisis? Let's be clear, you can't single-handedly fix a financial system with structural problems. But understanding how it works gives you options most people never consider. Think of it like driving in a storm. You can't stop the rain, but knowing how to handle your vehicle improves your chances of reaching your destination safely. Here's your personal financial defense plan and actionable steps. 1. Rethink safe investments. Government bonds were once considered the ultimate security blanket, but in an era of central bank interventions and negative real yields, they may not protect your purchasing power. Build a diverse portfolio that spreads risk across multiple asset types. Real estate, commodities, international markets, and alternative assets can provide protection when traditional markets falter. 2. Diversify geographically. When you invest exclusively in your home country, you're making a concentrated bet on a single economy. Spreading investments across developed and emerging markets reduces risk and provides exposure to different growth patterns. Many everyday investors now have access to global investments through ETFs and mutual funds. 3. Consider currency diversification. The dollar's status as the world's reserve currency isn't guaranteed forever. Holding modest positions in other currencies can protect against domestic inflation or currency devaluation. Some investors maintain accounts denominated in different currencies or invest in funds that offer this exposure without the complexity of foreign banking. 4. Time decisions with monetary policy cycles. When central banks raise interest rates, delay taking on long-term debt for major purchases like homes. When rates are being slashed and liquidity is flooding markets, fixed-rate debt becomes more attractive as inflation often follows monetary easing. 5. Build tiered emergency reserves. Rather than keeping 3 to 6 months of expenses in a savings account, consider a tiered approach. Keep 1 to 2 months in cash for immediate needs, another portion in treasury bills or money market funds that offer better yields but remain accessible, and a third tier in slightly less liquid but potentially higher-yielding options accessible within a week if necessary. 6. Understand asset performance across economic conditions. When stock markets decline during recessions, sectors like consumer staples, utilities, and healthcare often experience less volatility. When inflation spikes, assets like real estate, certain commodities, and inflation-protected securities typically outperform cash and bonds. Construct a portfolio diversified across economic scenarios, not just investment categories. Take Sarah, for example. She was a mid-level marketing manager who studied economic cycles after the 2008 crash. By 2019, she noticed concerning valuation metrics and quietly repositioned her retirement accounts to include more defensive assets. When markets plunged in 2020, she maintained her investment strategy and even deployed some cash reserves during the recovery, significantly outperforming many of her colleagues who panicked and sold at the bottom. 7. Take a nuanced view of debt. Fixed-rate debt can benefit you during periods of high inflation, as you're essentially repaying with devalued dollars. Variable-rate debt becomes particularly dangerous when central banks are hiking rates. Make strategic decisions about when to borrow, when to refinance, and when to prioritize debt reduction. 8. Recognize financial incentives and conflicts. When a bank or investment firm offers you a special opportunity, ask yourself, who benefits most from this transaction? Understanding the revenue models behind financial products helps you spot situations where your interests might not align with those selling you services. 9. Maintain financial flexibility. Avoid situations where you're forced to sell investments at inopportune times. Having multiple income streams, keeping reasonable cash reserves, and avoiding excessive leverage gives you the ability to weather financial storms without making panic-driven decisions. 10. Understand market cycles. While perfectly timing markets is impossible even for professionals, recognizing when asset valuations have reached extreme levels by historical standards can help you adjust your exposure. when metrics like price-to-earnings ratios or home price-to-income ratios reach historically unprecedented levels, become more conservative with new investments. 11. Use institutional protection tools. Option strategies like protective puts can limit downside risk during volatile periods. Dollar cost averaging, systematically investing fixed amounts at regular intervals, reduces the impact of market timing on long-term results. 12. Track your personal inflation rate. The official inflation rate might not reflect your actual experience. By tracking inflation based on your specific expenses, you can make better decisions about salary negotiations, investment returns needed to maintain purchasing power, and which price increases to offset through budgeting. 13. Commit to continuous learning. The financial landscape constantly evolves, with new products, regulations, and market dynamics emerging regularly. Dedicating even a few hours monthly to understanding these changes puts you ahead of most people who set their financial strategy once and rarely revisit it. 11. The knowledge advantage. While financial experts focus on teaching you where to invest your money, they rarely mention the real advantage that separates winners from losers in the economic game. Ever wondered why billionaires seem to navigate economic downturns with ease while everyone else gets crushed? The answer isn't what they own, it's what they know. We've taken quite the journey together, haven't we? From following your student loans' wild ride through the global financial system to uncovering how banks create money out of thin air. We've peeked behind the curtain at the Federal Reserve's enormous influence on your daily finances and watched as quantitative easing pumped trillions into asset markets. We've exposed the shadowy world of dark pools where Wall Street insiders make their real moves and identified warning signals that the smart money is sending right now. We've connected distant geopolitical dominoes to your dinner table costs, examined who's actually winning in today's financial system, and outlined practical strategies to protect yourself. That's a lot to take in. But here's the thing, there's a massive difference between people who understand these mechanisms and those who don't. It's like walking into a casino where some players know the exact odds of every game, while others are just pushing buttons hoping for the best. The house might still have an edge, but who do you think walks away with more money at the end of the night? Financial literacy is the skill that determines whether you'll be prey or predator in the economic jungle. Imagine having a cheat sheet that flips the odds in your favor. That's what financial knowledge gives you in today's complex economy. Let me share something disturbing. According to the FINRA Foundation, only 34% of Americans can correctly answer 4 out of 5 basic financial literacy questions. Most people are making life-altering financial decisions based on incomplete information or completely wrong assumptions about how money works. The average person spends thousands of hours mastering their profession, but barely a fraction of that time understanding the system that determines what their labor is actually worth. They'll agonize over saving $50 on a flight while remaining clueless about monetary policies that silently extract thousands from their savings through inflation. They'll stress about a 0.1% difference in mortgage rates while being completely unaware of massive wealth transfer mechanisms happening right under their noses. Knowledge translates directly to money in this game. A 2020 study by the Global Financial Literacy Excellence Center found that people with strong financial knowledge accumulated nearly 3 times more wealth than their less informed peers, even when controlling for income and education. The TIAA Institute revealed that adults with high financial literacy spend 13% less on transaction fees and are less likely to have high-cost debt. Over a lifetime, we're talking hundreds of thousands of dollars. The true value of financial system knowledge goes beyond personal gain. It's about seeing the matrix of money that shapes every aspect of our society. Once you understand how the financial plumbing works, you start recognizing its influence everywhere. In housing policies, healthcare costs, education access, retirement security, and even the foods available at your local grocery store. You also gain immunity to financial gaslighting. When a politician claims that printing trillions won't cause inflation, you'll know better. When Wall Street tells you to buy while insiders are selling, your alarm bells will ring. When conventional wisdom says to follow the traditional path while the economic landscape is fundamentally changing, you'll have the confidence to chart your own course. This isn't about becoming a conspiracy theorist. It's about becoming a clear-eyed realist. The financial system is neither inherently good nor evil. It's a human-created tool that produces predictable outcomes based on its design. But those outcomes don't affect everyone equally, and knowing the real rules of the game lets you position yourself accordingly. What keeps me up at night is the knowledge gap, the growing divide between those who understand these systems and those who don't. In a world where financial complexity is increasing exponentially, this gap threatens to create a permanent underclass of the financially confused who are perpetually exploited by those who know better. That's why I'm asking you, don't keep this knowledge to yourself. The financial system works partly because so few understand it. If you've absorbed even a fraction of what we've covered, you now know more about money creation, central banking, and financial markets than most of your friends, family, and coworkers. Share what you've learned in small conversations. When someone complains about inflation, mention how it connects to monetary policy. When retirement comes up, explain how market structure affects their 401k. When student loans enter the chat, briefly describe where that money comes from and where the payments go. Invite others to join you on this learning journey. Financial education isn't a zero-sum game. When more people understand the system, we all benefit from more informed voters, more transparent markets, and better financial products. Teaching others is also the best way to solidify your own understanding. Don't stop here. The financial landscape is constantly evolving, with new products, regulations, and market dynamics emerging regularly. Commit to spending just a few hours each month deepening your financial knowledge. The return on that investment of time will dwarf almost any stock market return you could hope for. So where do we go from here? As individuals, we can use this knowledge to make better personal financial decisions. But collectively, we face a more profound question. What kind of financial system do we want to build for the future? The current system wasn't handed down from the heavens on stone tablets. It evolved through human decisions, policies, and compromises over centuries. It can be changed. It can be improved. But that won't happen if most people don't even understand how it works now. We've been on quite the journey together, diving into the financial matrix that shapes our lives every single day. Whether you realized it or not, this hidden system has been influencing your bank account, your career options, and even your retirement dreams since before you got your first allowance. Every swipe of your debit card connects you to this vast, invisible network we've been exploring. This is your economy. Most people go their entire lives without peeking behind the curtain. But not you. Not anymore. Your financial superpower is awareness that illuminates your path forward. Keep questioning, learning, and staying curious. Understanding money is the most valuable asset you'll ever own.